Okay, so now we're going to go over the calculation of business income. So first of all, business income for taxes is different than business income that like a company would report on their like their income statement, right? Like so their income statement, they'd have like revenues like depreciation. They'd have a whole bunch of revenues and they'd have expenses like depreciation. But one thing is for tax, we do not use depreciation, right? We use CCA. And aside from that, there are like a whole bunch of other rules. So the thing is, the final net income at the bottom is actually not correct. Like for tax reasons, it's not correct, which means that we have to adjust it. So what we have to do is first we start off with net income at the very bottom. We start off with the net income at the bottom, and then we add and subtract like a whole bunch of stuff. Okay. This, I probably should have mentioned that in the other video. This is not like a full list of things. These are just things that I sort of was having trouble with. To mention that. Okay, whatever. These are just some things that, I don't know, like they seem kind of important or they pop up a lot. So first of all, in net income, in the other income section over here, like in their income statement, they would also say stuff like, oh, like gain from sale of business or gain from sale of shares, stuff like that. The thing is, those type of things, if you remember, those things are not part of business income, right, or employment income. Those things over here are taxable capital gains, okay? Which means that those things have to be like removed from the income. So if you have some other income that's included that shouldn't be in this net income, you have to subtract that. So you subtract any interest income, which falls under property income, or any gain on sales of equipment and land, which are part of capital gains. Okay, another thing, oh crap. One thing is for sale of land, like if they say like, oh, like we had like this much of a gain on the sale of land, you're gonna have to read the entire question to see why the land was bought, because that would determine whether it's business income or capital gain, right? Like remember how like if you buy a piece of land with the sole purpose of selling it in the future for profit, oh no, the hell did I do? Okay. Land for purpose of, I shouldn't write its purpose, selling it in the future for a profit, that would be considered like inventory. Like you're buying something cheap and then you're selling it at a high cost. So that would be considered like selling inventory, which falls under business income. However, if you're first at the date of acquisition, remember this is all the date of acquisition, not like later on I'm changing my mind or whatever. A date of acquisition, if instead your reason for buying this is because, I don't know, you think that you can use it like rent income or something like that, like you're planning on renting it out and like getting some income from that or some other like long-term gain from this thing, that would be considered a capital gain. So this thing over here would be taxed, remember, 50%, whereas this one over here would fall under business income and be taxed at like whatever income like your business is. I mean, not taxed at 50%, like only 50% is taxable. So that is one thing. And one thing that I like to mention is that, so technically, nobody really knows the purpose that you buy it, right? Like you could just lie. You could just be like, oh, like you could really buy it for this, but then you lie and you say, oh, I was obviously trying to like use it for like rent income, you know? But, you know, like we're sort of assuming that people are truthful. So, first of all, property income. And so land, you have to determine why the land was bought, because that would determine whether it would go under business income, like properly, or if it's like, if we have to take it out because it's like a capital gain. Another thing to add is depreciation and amortization. Those are all expenses that they took out of your income and they're like, yo, that's wrong, add it back. So we add that back. And then we also subtract CCA, which is a proper depreciation. That's our first thingy. That's our first sort of section. Our second section is capital assets. So in general, all capital assets, they cannot be deducted, okay? No deduction, because they're like capital, right? So they sort of provide like a long-term benefit. They're sort of like an asset, right, on your balance sheet. They're not just like they're not just like an expense. One thing that you can claim on cars and planes, I think, is CCA. But other than that, you can't really claim CCA on anything else. So you have to add back most capital assets. So things you have to add back are books because they provide like a long-term benefit. Stock-based compensation. So this one over here, wait, why did I put capital? I don't know why I put this one under stock capital assets. I don't really know if this is it. Stock-based compensation is basically like if I were to pay my employees with stocks, I guess. And like it's sort of like capital-ish in a way, so in that case you have to add it back. It's not like actual cash that's being like taken out of my account, out of like the business, I mean. Another thing is, okay, so cost associated with purchasing shares. Shares is a capital asset, okay? So any cost associated with purchasing shares are part of capital assets. For example, any broker's fees, whatever, those things you have to add back. Those things you have to add back over here, and they can be added to the cost of the actual shares for like CCA deduction. Wait, shares are CCA deducted? What? Oh my god. Oh my god, I totally, wait. Okay, I think this cars and plane CCA is a bit, I messed up. I'm mixing stuff up because obviously there's so many other, you know, like all the CCA classes, like class 1, 2, 3. So like, I think I was wrong about that. But anyway, what was that? Cars and thingy. What? Whatever. Anyway, so cars, shares, the capital assets, you have to add that back. Another thing to add back is certain construction costs. So one thing is that the question might say something like, oh, like these are some legal costs associated with the warehouse. That case, that's not specifically construction, so that wouldn't fall under this category. For it to be like added back as a construction cost, I think the question has to like specifically say like this is for construction purposes. So for construction purposes, if you had any legal and accounting costs, any interest costs, any mortgage, property tax, promo costs, like promotion costs, those things you have to add back. Another thing is producing a commercial. That when you're like shooting, you're like, I don't know, hiring people, you're like creating something, right? Like since you're like creating something like out of scratch kind of, it's like a capital asset. It's like a capital asset, so you have to add it back. Another thing is a mailing list. So mailing lists, those ones like create some future benefit, and those ones are also capital assets. Another thing is the cost to design a warehouse. So for example, if we hire like an interior designer or like an architect and you have to pay them fees, those things are all part of the capital asset. They're not part of like they're part of the cost of the warehouse. So those ones you have to add back to this capital. You have to add back to the net income. Next, we have anything related to the articles of incorporation. Articles of incorporation is also a capital asset. One thing is if you actually look at the CCA stuff, like if you look at the CCA classes and everything, most of the things, like for example, articles of incorporation, I think is like class 14.1 or something like that. And that thing is like you can deduct CCA on it because it's like a capital asset. So anything that's related to articles of incorporation, you can deduct. Those kind of things you have to add back to income. Another thing is appraisal cost for share valuation. So share valuation, remember that's related to shares. Anything with, remember this is, okay, so the thing is if this is like your own shares and you're appraising it for whatever, that one, it would be considered a capital, like sort of capital cost because it's our own shares. This would be different from like if we were issuing shares, in which case that would be something kind of different, which we'll be going over next. This one just like sort of like valuing our shares, and that's fine. Couple of things that are capital assets, but you don't actually have to add them back are landscaping. Landscaping, even though this is like CCA, you don't have to, I don't know, for some reason, the law say you don't really have to add this back to income. You can like, in the year that it was paid, whatever cash was paid for landscaping, or like however like you pay like credit card or whatever, that stuff you can leave as it is. You don't have to add those back. Another thing is site investigation. You don't have to add that back either. Legal fees for patent registration. So the thing is, patent registration, I guess it's like really expensive. So they want to make it easier on you and make it more likely for you to like, I don't know, do patents, or I guess. So because of that, you can leave that as an expense and you don't have to add it back to your cost. Another thing is airing a commercial. So whereas producing a commercial was like creating like an actual thing, so that was like a capital asset. Airing a commercial is just like sort of like promotion cost. It's just like a cost to earn income, so you have to. Oh yeah, so that one you don't have to add back. It's just like a normal expense. It's like a normal expense part of the business. So one thing that's cool is like R&D, you can deduct the full amount. So if they did something like amortizing, like let's say the R&D costs like 25K, and the business decided to amortize it over 5 years, so 5K each year. Instead of doing that, you have the option of actually just deducting the entire 25K in the year that was paid. You can do that, or alternative, you can also just carry it forward like for the next year. So like, for example, in like year 2026, when the company is doing like really well and your income is like super duper high, you can bring this, you can decide to like bring in the R&D expenses to reduce your income, to like reduce the taxes that you pay, stuff like that. So R&D you can deduct the full amount right now or later. I think you can also deduct like however much you want. I don't know if you can like deduct like 50% today, 50% next year. I don't know if that's like an option, but you sort of have the option of deducting full amount. That's one thing. One thing is car costs. Okay, so that was all capital asset stuff. So car costs. So the thing is, let's say that the question says we have like a company car, and the interest on the car that we paid was we paid like $44,000 for the year. Well, guess what? The car interest is limited to $300 times months. So 300 times 12 equals 3,600. This means that this is a maximum you can deduct, which means that while in the actual expenses, and thing is over here, it's going to say plus because it's the cost. So what this happens is, okay, so how do I explain this? So if I go over here, so here's my revenue, here's my expenses, and my interest says it's $4,000, okay? My revenue is $10,000, and my total net income is, let's say that this is like the only expense or whatever, it's 6K. But the thing is, this isn't actually this is not the interest that I can deduct, right? Like the only interest I can deduct is actually 3,600. This means that I have to increase my net income by the 400, right? The 400, that's sort of like different, because if it was actually 1,000, 10,000 minus 3,600, then it would be 6,400 would be the true net income, right? So if I want to increase this thing by $400 using these two numbers, that's just 4,000 minus 3,600. That's why for my calculation over here, I wrote the given interest on the cars, like whatever that business actually like deducted, minus the correct interest that you can deduct for tax purposes. Obviously, like that's just the way that I think, so that's how I'm writing it out. But like if you have like other ways, that's fine too. Same thing for the lease costs. So that if you have like you have to add the lease cost that the company deducted, and then subtract the actual lease on the car that you can deduct. And the actual lease is limited to 900 times the number of months. Coincidentally, this is also the one that's this is also the same limit for employees. So if an employee were to use a car, how much could they deduct? Okay, next category we have are dumb costs. Just costs that like why would you even include these? Club dues. No club dues. Also, no, like none of that like spa stuff. Like in employment income, I forgot to mention that in, but in employment income, there's a thing where like if you're part of some kind of like club or some kind of like, I don't know, organization, I guess, and it's like purely for the benefit of the employer, then you can deduct it, right? You can deduct it as like a deduction. Wait, no. If you're an employee and you get like some kind of like free benefit to like some kind of club, if you get like free like membership to the club, if that membership to the club is purely for the business purposes, like purely for like the business's benefit, then it would be a non-taxable benefit, because it's like not really something that is like, you know, your own personal benefit. Whereas if that club was something that was also like, it was maybe like a spa or something like that, and you can do it like on your own time too, like it's not just for the company's benefit, in that case it would be a taxable benefit. So in that case, as an employee, you have option whether it's a taxable benefit or a non-taxable benefit. But things as a business, any club stuff, and literally any club stuff, no matter what, it's always taxable. And as a result, you have to add them back to your net income. You cannot deduct those. Another thing is not political trash. This is political, some kind of, if you like ever support any politics, that you can't deduct. That's kind of dumb. Like, why would you even do that? Another thing is ad in a foreign company for Canadian people. So for example, so basically what the thing is, you are putting an ad in a foreign company, but it's targeting towards Canadian people. What the government wants to do is, the government obviously wants you to support other Canadian businesses. businesses, right? So if you're supporting some other random business in the hopes of capturing other Canadian people, that's not allowed. You can't do that. You have to add that back to your net income. Another thing is any payments related to the Income Tax Act. So if you have any interest on late payments, those things you have to add back, okay? And this is like a weird thing because in general, interest is always allowed. That's like one of the things that we're gonna go over. Interest is always allowed except for interest on late payments into related to income tax, stuff like that. That stuff you have to add back. Another thing is personal costs. Like if you like hire a nanny in order to work, or like some kind of stuff related to like a personal loan, you gotta add those back. Those are all personal things. Like get those out of here. Next is these are things that do not create income or they're not actual costs. So similar to depreciation was like also like a this is like not a real cost, but it just sort of made sense to put like depreciation with CCA because they're both related. But anyway, this one over here, non-income creating or not actual costs. So first of all, donations to charity, they're not it's not expense that adds to your income, right? It's not like you're donating to a charity in order to increase your income. That thing you have to add back because it doesn't really make sense. Another thing is Goodwill Impairment. This one is not a real cost, so this one you also have to add back. Now, we're going to go over stuff that is employee benefit related. So, CPP and EI, these are things that are taken out of the employee salary. This thing won't actually be like, I don't think this would ever actually come into question, but just like for like general knowledge, I guess. CPP and EI are things that are taken out of our employee salary, okay? It's not taken out of our salary, so it's not our cost, and so as a result, that's not something that we have to like add back or like subtract. Not something you have to worry about. I mean, it's not something that we have to add back. It's not our cost. Another thing is life insurance for employees. So life insurance, this one is like out of our own pocket. So we could, wait a second, hold up. If we're paying some benefit, so usually if it's a dumb expense, okay, right. So in this case, the government wants to be sort of like a good guy and let you like deduct costs for important life insurance. Because they're like, you know what, like, man, like, life insurance is important. I don't want you to be, like, sort of punished for the fact that you're, like, you know, adding to your, I don't know, your employees' life insurance policies, whatever. So we'll let you deduct that as an expense. Next is private health services plan. Same idea. Government wants to be a good guy. Pooled RPP, registered pension plan. Same thing. Our government wants to be a good guy. One thing you have to add, though, one other thing about RPP, though, is that for normal RPP, like not pooled RPP, but normal RPP, each employee can have funds out of their pension plan at a maximum of 18% of their salary with a maximum of $30,780. So for example, if somebody's income is $5K and I add $5K to their pension plan, I can deduct that entire thing as an expense. The only thing I can deduct as an expense is 5K times 18%. I have to make sure that 5K times 18% is limited to it's less than this 30,000. It obviously will be because 5K is less than 37,000. But like if your income was like really, like let's say it's like 600K times 18%, then you're gonna have like a really high like limit. But they're like, you know what? I don't want you to like deduct too much, so we're gonna cap it to like 30,780. So anyway, this over here, 5K times 18, that's like what 900-ish. This is a maximum amount that a company can deduct as part of their RPP contributions for this employee. And then if you have like another employee and their income was like 10K, then they have like a different amount, like a different maximum amount you can deduct. 1800. Oh, smart. Yeah. So similar thing for the deferred profit sharing plan. It's also like a maximum 18%, and this one is limited to 15,390. It's like just like a different limit. Are we almost done? Please tell me. Oh, we're almost done. Good job. So reserves. So okay, before I go into reserves, I'm gonna go into an explanation on reserves because reserves are kind of confusing. So this is what a reserve is. Basically, in a reserve, I'm setting aside a bunch of money this year to use it in the next year, or I'm gonna deduct some amount from my income this year, but I'll add it to my income next year. So for example, let's say that I sold some products, right, and my revenue equals like I don't know 12K. But the thing is, I expect that about 6K of those will be returned. So like truly, you know, my revenue like if you had to like think about it, would be like 6K, right? So this is something, this is called a reserve. Basically, I'm saying, yo, like I don't think I'm gonna be getting this money, so I'm gonna put this down as a reserve for returns, I guess. And this thing, I would deduct this from my income, and so my this year's income, my 2022 income, is gonna be 6K. So that in 2023, when I do get these returns, like here's the thing, there are two options. Okay, whatever. In 2022, when I do get these returns, I can be like, oh, see, like look, see what I told you. Like if I had done it at 12K, I would have had to pay a lot of tax. Whereas since I would have had to pay a lot of tax on income that I am not even getting, because like half of that was like literally going away, right? So that's what a reserve is. It's sort of like some kind of like sort of holdback. Like for some reason you're sort of like subtracting your revenue, or you're adding to your expenses for whatever reason, to like, I don't know, signify that there's something that is sort of a contingency-ish. Now, for example, we have a reserve for, what is this thing over here? Reserve from revenue from sale for delayed payment. Okay, so for example, one reserve that we can do over here. So according to GAAP, let's say that I sold something, and I told the person you can pay to me over the 2 years. Okay, so I sold it to them for like $200, right? So like that's the revenue that I get. And expenses, like these are just like random expenses, like doesn't really matter too much what the expenses are. But basically like my revenue this year's $200, but things I'm actually getting the cash like within like 2 years, right? And in like an actual income statement, how does it look? It's like cash, AR, revenue. This one is 100, this one is 100, this one is 200. And since revenue is the one that we look at, we have to put, as part of GAAP, we have to put revenue over here. One thing about tax reserve laws, one thing that tax allows is for you to be like, yo, like I'm actually not gonna be getting the cash all 200 this year. I'm gonna be getting it a bit next year. So you could do, according to tax laws, is being like, here's my revenue, the $200, same thing, but we have this reserve for delayed payment. We have this reserve for a payment that I'm going to receive in the future, and that one is, I'm going to subtract today's revenue by $100 to sort of make up for that. And one thing is, the next year, I'm going to be adding it back to show that next year is when I'm going to be getting the rest of that income. So if we look at this example, in the beginning, our total income is 170 minus 30, which is 140, which is the exact same as here, 140. The only difference is that the value of the income is different across these 2 years. It's 70-70 versus 170-30. So reserves are like a cool way to maybe like move income from one year to the next, and if you like want to decrease your income by some amount. One thing is you can't do this reserve thingy for everything. There's only a couple of things you can use reserves for. Two things. One is account for doubtful accounts and delayed payment of revenue. Delayed payment of revenue is the example that we just did right now, where something's sold right now, but you won't be getting all the, you won't be getting all of the money, or you won't be getting like a portion of the money until like later on. For account for doubtful accounts, for this one over here, when you're using account for doubtful accounts, you can't just be like, oh, our ADA is like 18% of accounts receivable, so this is going to be our reserve. You can't do like that. It has to be very specific. You have to be like, oh, like we're not expecting stuff from this customer, from this customer, from this customer. We're not expecting 6K from them, 12K from them, 13K from them, stuff like that. Or something like, we haven't received payment for like 90 days from like, you know, some people. So from those people, I'm not expecting to get any income. So like, if it's like somewhat specific, like not just like a general number part of AR, not just like a guess, somewhat specific, then it's allowed. It's a reserve that's allowed. But things in general, normal reserves, like general reserves, are not allowed to be deducted as part of your income, and you have to add those back. The only thing that you can let stay in your like expenses section is a specific ADA or the delayed payment of revenue. Okay, cool. Next thing is, so in general, so interest in general is allowed, like you can like leave it as like an expense. One thing that you can't let stay in there is anything. So for example, this one here, funds borrowed to purchase land. This one is sort of like land related, right? So it's sort of like, see, it's like a capital asset-ish. Another thing is property taxes on the okay, yeah. Oh wait, hold up. Never mind. Oh, I'm dumb. Okay. I didn't read the full sentence. So one thing is that interest and property taxes on vacant land is limited to the income from the land. So, for example, let's say that I have like let's say that you have like a huge like plot of land, and it's just like land that just stays in my account. Like I'm not getting anything from it. But let's say that I have to pay like interest because I borrowed money to buy it, and I also have to pay like property tax. Those things I cannot deduct. Okay? I have to add those back in. But if I was earning some income, let's say I was like maybe like renting this out to like kids or whatever for to like play out in the grass. I'm not really sure what type of rental income you can get from like an empty plot of land. But like whatever type, I tried Googling, but I couldn't find anything. But anyway, let's say that I got like some rental income of 6K a year, right? Like 6K a year. That means that the interest and property costs that I have, I can deduct them up to 6K. Like I have to make sure that my income does not exceed, I have to make sure that my expenses don't exceed my income. Because basically the thing is that all expenses, because like the gist is that the expenses that you incur can only be deducted if they were used to generate income. If I'm leaving it alone, if it's not generating any income, that's kind of dumb. Like this expense does not count. But if I am generating some income, then you can sort of use it to like a limit. Okay, next one. Next section is sort of like just like adjustments. So some type of adjustments you have to add are any adjustments to liability warranty fixes. Like for example, I recorded warranty expense, like I recorded something like warranty expense of like 12K, but the only type of like actual expense that I incurred was 8K. In that case, $4,000 of that expense was not actually like a real expense, so I have to add those back. Inventory adjustment. So one thing is inventory should be measured at fair value or lower of cost and fair value. So if at any point, if it's not the correct amount, you have to adjust this, okay? So how to adjust this one? Inventory adjustment. Because, I don't know. Because sometimes I mess up whether it's supposed to be like adding or subtracting. So for inventory adjustment, let's say that my 2017, what was it, fair value, I think? Like fair value was 27K. And 2018, when I'm doing like my whole like cost of goods sold, I've got my beginning inventory. This is a fair value of ending inventory. And in 2018, my beginning inventory is 28K. My purchases are 16. My sales are like negative, I don't know, 8. And then my ending inventory is something, and then I get to my cost of goods sold of something. Let's say that my cost of goods sold is 20. Let's say it's 32K. Now, in this case, there's a problem because I said here that the fair value, remember beginning inventory over here, remember this beginning inventory, I put it down as like cost. When I'm recording my cost of goods sold, I am recording this thing as cost. But thing is, it has to be at market value or lower of market value and cost. So you can't really use this, you have to use 27K. So basically, you have to adjust this for the correct amount. So if this was actually 27K, then when you add up this stuff plus subtracting this, and you end up at your cost of goods sold is actually going to be 31K. This is 32, by the way, and this is 31. Your cost of goods sold is going to be like one amount, like 1,000 less. Which means that in your net income, your cost that you recorded was too high. Which means that you have to add back a little bit of the cost, to make sure that it comes back to here. Okay, so you might be thinking, oh, if it's actually less 27 versus 28, 27 is less than 28, so you have to like subtract it from the cost. No, you have to add back, because you have to remember, you have to go through the entire process. That's what I would suggest, to see like what the actual number should be. And so is the cost too high or too low? And if it's too high, you add it back. If it's too low, you can subtract a bit more cost. That is for inventory. Let's see. Next, bonuses. Okay, so the thing is for bonuses, let's say that the company says, okay, you're getting like a bonus, but it's not being paid out until like July. If it's not being paid until like July 30, that case, it would go under the next year's business income. So within, if it's paid within 180 days, so let's say that you're earning income, earning a bonus in November 2020. 2020? This is 2021. If I receive this bonus in cash before June 30, then I can include this as part of business income. If it's past that, then it would be considered as part of next year's like bonus expense or whatever. Bonus, earning bonus, I can deduct it here as bonus expense. So if it's within this section, so the thing is, as part of like our net income, you know how net income is always on an accrual basis. So for them, when they record like bonus for like a person, when they type in like bonus expense for like some person, they're gonna write down the entire amount. They're gonna be like it's gonna be like 40K. Okay? No matter when they're gonna actually get the cash, they will write down the bonus expense because it's been earned. But things for tax purposes, it has to be only earned within this amount. So if it's within this amount, if your bonus is paid out or it will be paid out within this timeline, then you can leave it in as an expense, it's all fine. But if it's gonna be paid out after that, then you're gonna have to add back that bonus expense. So which is why it's either zero, like no change to the no adjustment, or you have to add it or add. I should have mentioned that, I guess. Another adjustment is rent expense. So basically, for rent expense is always about like the full amount that's paid in cash. So like if you sort of like, I don't know, try to like depreciate the rent expense or something like that, don't do that. It's just a full amount that's paid in cash. Another thing, this is different from rent expense for like some weird reason. But if you get like some kind of multiple year insurance, like for example, like a fire insurance, and it's like for like 3 years, you can only tax it for the years that it's used up. So like you can only deduct it for this year. So add back anything that was not for this year. Oh my god, we're almost done. Okay, other random expenses you have to add back are meals and entertainment at 50%. So these ones, I think these are like, I don't know if these are like personal meals or like client meals. It doesn't say anything. I think it's client meals probably, right? I don't really know. Just like, okay, I think it's both actually. Like no matter what, it's just always 50%. Cost of borrowing money. So anything that's related to borrowing money can only be deducted at 20% each year. So you have to add back the 80%. So for example, if there's like some kind of finder's fee for mortgage, or some kind of like lawyer fee for mortgage, or something like for mortgage, or something like for the issuance of shares, anything that's related to like borrowing money. Remember, issuing shares is also like something that's related to borrowing money. Oh yeah, it would be okay. That would be technically, it would be called like financing expenses. Do I have financing expenses? Okay, so I don't have them included here, but in general, any expenses that are used for financing reasons, so loans or where did I write this down? I could have sworn I wrote this down. What the hell? Okay, whatever. Loans or issuing shares, those things are gonna be always only taxed at 20% each year, so you have to add back 80%. Another other expenses that you can keep in. So one thing is, if you work at home, you can only include it in the deductions if it's a principal place of business or it's used only for earning income. In that case, then you can leave it alone. If not, you have to add it back. Another thing, else add back, else it's a plus. Another thing is legal fees for representation. Like for example, if you want to like represent yourself at like some kind of like, I don't know, like court or like some kind of like government thingy, that type of expenses, those things are allowed. You can deduct them. Convention expenses, I'm not really sure what this means. I think it's like attending like a business convention, for example. That thing would be, you can deduct that. Last one is utility service connection. Not really sure what this one's either. Like maybe just like having like Bell people like come in and like making sure that your utilities work and like just setting it up, I guess. That thing would also, you can also deduct that. I guess maybe that's sort of like you're like starting your own, like maybe that's like an expense that you incur when you're like starting a business or like starting or like going to like a new place. So because of that, they're like, you know what, like, you know, you're like starting a new chapter, we'll give you a benefit. So they're like, we'll let you deduct this. Okay, We're almost done, guys. So now we're going to go over loss. So this is a loss. This is not business income. This one is over here. Okay, this one over here. So there are two different types of losses that sort of like I came up for me. ABIL, allowable business investment loss. This one over here. This is the loss on the share of shares, loss on the sale of shares of a small business corporation. If they ever say that you held shares of a small business corporation and you sold them at a loss, then that would be a ABIL, allowable business investment loss. And the amount that you can deduct is 50% of the loss amount, just like for like reasons whatever. Another thing is a farm loss. Like let's say that you like partnered up with somebody to like run a farm, and if farming isn't your main occupation, then the maximum loss that you can allow is a lesser of these. There's a hard limit of 17,500. There's also your actual cost, like your actual cost according to like the question, like the text question or whatever. There's also like a formula here, 2,500 plus 1/2, and the difference between the actual cost minus 2,500. Whichever one of these is lower, that's the amount you can include as part of your farm loss. Okay, that's it for business loss, business income.